Welcome to the GetRealWealth.com radio show, where wealth means a lot more than just building a second stream of income. Listen and learn how 70% of the millionaires in America used real estate to create a lifestyle that most people only dream about. A lifestyle that includes good health, family, romance, travel, charity, and all the other parts of a balanced life. Now, here is your host, real estate investor and mentor, Steve Davis.
Welcome back to the GetRealWealth.com radio show. I'm your host, Steve Davis. If you have a question for me at any time, please feel free to email it to me at asksteve@getrealwealth.com, asksteve@getrealwealth.com. This question comes from a Herbert. Now, I did answer this on my show in Dallas-Fort Worth yesterday. So this is the second time I've covered this material, first time in Houston. And it's basically, let me read it to you. Again, his name is Herbert. He says, "Hi, Steve. Could you answer on your radio show about debt to income buying rental property? The bank only counts 75% of the income to help you qualify for more property." And then he goes, so there's really two questions in here. The second question is, would you talk about my friend who makes $100,000 a year and he wants to buy a $60,000 Mercedes-Benz. Now, here's what the guy goes on to say. "I told him to buy some rent property, so the rent property can pay for his car in case he loses his job. But he doesn't want to do it. Could you give some insight on that?" Well, it's actually very simple. Let's go to the DTI first, debt to income ratio. A lot of people have the fear that after they buy one house, and the reason they have this fear is because when they bought their personal residence, it was all about DTI, how much money you got in the bank. And they barely qualified for that. So in their brain, they go, I can't qualify for another property. Well, that's just not true. See, Fannie Mae is set up to give you 10 loans. Fannie Mae government loans, one for your house and for 9 rent properties. And the way they're able to do that is because they count 75% of the rent. So if your rent is $1,550, they're saying that $1,162 is the actual rent. That gets added to your income, reducing your debt to income ratio and allowing you to buy more property. Now, here's what's neat. After you've been at it long enough to have a tax return, the banks start counting the real rental amount because you can prove it on your tax return. So, and it gets even better once you have 2 or 3 years of history. Banks start leaning over backwards trying to give you money to buy more property. Remember, that's their job, to loan money out. That's how they make money. They're not your enemy. They're your friend. You know, I hear people bad-mouthing banks all the time. They didn't do this. They weren't that. They didn't want to help me with this. Listen, they're in the business to loan money. If you're credible and you have a good deal, they're going to give you the money. If you didn't get money from a bank, there's a couple of problems somewhere. Either credit is poor, or your consumer debt is so high you actually do have a bad DTI, or the deal was no good. You know, I had to walk away from an apartment complex because I couldn't get financing on it because the strongest bank I had said no. They said, that's not a good deal. Well, it turned out they were right. So your bank is not your enemy. Your bank is your friend. But just remember, you get to count 75% of your rent initially, and then after you have some tax returns to prove your rental income, you get to count it all. And that's why people are actually able to have 100 mortgages. There was one guy with 123 mortgages. So that's the DTI answer. Next, let's go to the gentleman who makes $100,000 a year but wants to spend $160,000 on a Mercedes-Benz. And he's saying, give me some insight on that. Here's what goes on. Herbert, the average American is conditioned to buy toys first, and they invest later. And therein lies the entire problem. See, people are told that the goal is the car. People are told that the goal is the expensive house. People are told that the goal is the expensive furniture, the clothes, the jewelry. And so that's what they do. They go out and get that. But no one told them that that was not the goal. The goal is, the first priority goal is passive income. And with the passive income, you buy the cars, the houses, the clothes, the jewelry, and so on. What this gentleman should do, one, it's concerning that a guy would go buy a car that is more than what he earns in a year. I don't know if that's just my rule, but that is, to me, that's crazy. It's 60% more than what he makes in a year. I'm really uncomfortable with that personality that wants a status symbol that bad that he's willing to go into debt that much. Now, if you say he's willing to pay cash for it, just as ineffective. That would be insane. Because, let's switch over to Ferrari, because I told you I'd talk about the Ferrari, but it's the same story. How did I get a Ferrari and never have to make a payment on it? The way was, instead of taking the $300,000 that the Ferrari cost, you take that $300,000 and go buy yourself 15 rent houses. It's that simple. 15 times $400 a month cash flow is $6,000 a month. $6,000 a month. That Ferrari costs, including insurance, gas, maintenance, about $4,000 a month. Do you see how those 15 houses pay for the Ferrari and leave you $2,000 spending money so you can travel, romance your wife, whatever you want to do with that $2,000? It is ludicrous to go buy the toys first, because it's taking all of your investment away. It's like people who have 5,000 square foot homes and they make $100,000 a year. Have you lost your mind? Yes. The ego pushed you into that big house, didn't it? You don't need that big house. Technically, unless you have like 8 kids, nobody needs a 5,000 square foot home. It is a status symbol. It is for fun. It is for ego. That's what it is. And it's a liability, not an asset. Remember this rule. Assets put money in your pocket every month. Liabilities take money out of your pocket every month. What is your personal residence? It's a liability. You have to pay principal, interest. Even if it's paid for, you still have taxes, you still have insurance, and you still have maintenance. There is no such thing as debt-free real estate. Even if you pay it in full, you still have taxes and insurance and maintenance. So, this gentleman, and we'll go back to the $160,000 car, he could literally go buy 10 houses, just about. My average out-of-pocket on my last 20 houses was $18,000. He's at $160,000. So about 10 houses. Let's just say 9. 9 times 400. That's $3,600 a month profit on those houses. That will pay for his Mercedes-Benz and leave him $1,000 or $1,500 to do whatever he wants to with. Again, for travel, romance, or whatever. Or to buy more houses. But please, Herbert, hug your friend. But if he heads to the Mercedes dealership, tackle him and choke him out. It's just a horrible idea. The other mentality that's inside someone who would pay more than he earns in a year to buy a car is they're not understanding this question. He's buying toys, the Mercedes, out of his earned income. So what he asked was, how can I afford this? And he went and looked at his earned income. He goes, well, the payment on this is going to be about $2,000 a month, insurance, gas, $500. So it's going to cost about $2,500 a month to own this Mercedes. And so he looked at his $100,000. Wrong. You don't look to your earned income for toys. It's your second stream of income that pays for your toys. Now, there's one other mentality that question that I asked, how can I afford that, is actually the correct question to ask. What you never want to say is, I can't afford this. Anytime there's something in life that you want that's going to bring you joy, happiness, it could be a bigger home, it could be a Mercedes-Benz, don't say, I can't afford it. Say, how can I afford it? And the answer is always by investing in income-producing assets. All right, this is the GetRealWealth.com radio show. I'm your host, Steve Davis. You can reach me at AskSteve@GetRealWealth.com. My email is AskSteve@GetRealWealth.com. You're listening to AM 700, the voice of Texas. Thanks. Did you know that 95% of Americans fail to retire by age 65 and 36% are dead? The good news is that here at the GetRealWealth.com radio show, we know what the other 5% are doing. 70% of them own real estate. We are a mentoring group for new and experienced real estate investors. We will show you how to build a second stream of income that will allow you to retire at any age. I will be explaining this at a free 2-hour introductory workshop this month. If you would like to attend, please go to GetRealWealth.com. That's GetRealWealth.com. Welcome back to the GetRealWealth.com radio show. Remember, you can always find us online at GetRealWealth.com. I got an email here of someone who wants me to reserve a seat for Thursday night's workshop. I cannot reserve you a seat. To reserve a seat for Thursday night's 2-hour free introductory workshop, go to GetRealWealth.com. In the upper right-hand corner, it will say free workshop, and that will give you the dates and the location, and you can reserve a seat there. We do require reservations because our office is not complete, so we're working out of a hotel with only about 50 seats. So please go to GetRealWealth.com. Upper right-hand corner is free workshop. Reserve a seat, and I'll look forward to seeing you there Thursday night at 6:30. Okay, my email is open to you for any other question at AskSteve@GetRealWealth.com. AskSteve@GetRealWealth.com. So in the last segment, and I got one email about it, this person wishes to remain anonymous, but they basically are saying, wow, this is some personal stuff, so I'm not going to read it. I'm going to give you the gist of it. This is a person who is in their later years, doesn't say the year, and has always lived their life buying toys out of their earned income. Now retirement approaches, and I've got to do something different. Well, the first thing, do not get discouraged. Do not get discouraged. I don't care if you're 65 or 75. You know, the little joke about there's no expiration date on your foot is very, very true. You don't know whether you're going to live to 85, 95, or 105. So you want to forgive yourself for past behaviors. Remember this, Tony Robbins, the past does not equal the future if you change your actions, but you've got to change what you're doing. So my request is, please go to GetRealWealth.com and click on that free workshop. come to that free workshop on Thursday night, and I will show you how to change the next 5 years, 10 years, 20 years, or whatever. But again, please do not get discouraged. Do not beat yourself up. That has absolutely, there's no use for that. It accomplishes nothing. Be willing to change, be willing to get educated, and be willing to take action. And the next 5 years or 10 years can be completely different from the last 5, 10, or 20, or 30, or however many it's been for you. So thanks for that email, Anonymous. Okay, my email is asksteve@getrealwealth.com. Asksteve@getrealwealth.com. Okay, the next discussion is basically how to move and when to move from single family into apartments. And it's generally based on the amount of equity that you have, which leads to the point it also depends on the amount of equity or money that you start with. It would be foolish for someone with $120,000 and up to start with single family. You would definitely want to look at apartment investing from day one. Now, you may decide, look, I've looked at both. I see why apartments make a little more money, sometimes a lot more money, but I'm going to start with single family because I'm just scared to death. Okay, we can do that. But be aware that your mentor at Real Wealth Academy is constantly going to be pushing you to move to apartments, because that is one of the highest and best uses for your money on the planet. The next is, what if you have less than $100,000 and you start with single family and you get yourself up to 15 houses? Well, let's look at the numbers on them. If we're picking up about $25,000 equity on each deal, times 15 houses, you've picked up $375,000 in equity. Plus, you put up $18,000. Let's change that to $20,000 just to make it easy for the math, times 15. So you've got another $300,000 of your own money in there. You realize you have $675,000 sitting there? You could go buy you might even be able to buy a 50 unit apartment complex with that. It would make no sense to keep buying piecemeal one house, when you got $675,000 there and you can go buy a 50 unit. You jump from 15 units to 50 units in one fell swoop. And it's highly probable that you're going to do a 50 to 150% rate of return at the end of the second year if it's a value play, a good value play. So let's say it's 100%. I said it'd be somewhere between 50 and 150. We'll go right in the center, 100%. You turn that 675 into, what would double that be, 1350, $1.35 million in 2 years. Whereas to get the 15 houses, it may have taken you 5 years. Does that make sense? So when to change is generally based off of how your equity's sitting, and remembering the highest and best rule. You always want to have your money in the highest and best use. And if you're making 18, 20% cash on cash, and you can switch it to apartments and make 100% in 2 years, which is 50% cash on cash, that's going to be the better place to have your money. Now, there is a way to do this almost tax-free. Now, the reason I call it tax-free, even though it's technically tax-deferred, it's deferred till after you're dead. So it's tax-free to you. And the nice thing is, if you hug your kids, love your kids, and teach your kids correctly, they'll be able to do the same thing. They will be able to defer those taxes till after they're dead and the grandkids and so on and so on. I'm sure, I like to pick on the Kennedys because they have so much real estate. They're not paying taxes on that real estate. They don't sell it and go blow the money. They keep buying more and more and more real estate. So it's a thing called a 1031 exchange. I'm not even sure if I said it. It's a thing called a 1031 tax deferred, but again, the taxes are deferred till after you're dead, exchange. And what you do is you try to sell as many of those 15 houses as you can in a 6-month period. I've never seen anybody sell every one of their houses in a 6-month period. You got to get the renters out. You've got to get it fixed up if there's any damage, and you've got to get it on the market and sold. But let's say that you goof up and only sell 10 of them in the 6-month period that you're allowed to for the 1031 exchange. Then you pay taxes on the other 5 deals at 15 or 20% capital gains, depending on your income. So this is not a perfect solution tax-wise, because, again, it's very hard to sell 15 houses in a 6-month period. But with a little preparation, you can sell as many as, a lot more than if you just all of a sudden decide to do it. With proper planning, you can get 10 or 12 of the 15 sold, and the money will be tax deferred, and you can use it to purchase that apartment complex. So there's the 1031 in a nutshell. That's a terrible oversimplification of the 1031, which is why I just emailed Cindy Pham. She's going to call me back or email me back, and I'm going to try to get her on the show either Wednesday or Thursday, 2 o'clock, to discuss the 1031 so you can see how it works. It's relatively complex. You do need a third party to manage it for you. Cindy Pham does that. But she'll explain how it works. We'll even talk about a thing called a reverse 1031. I believe that's the term. And also putting money into the deal when you sell the other 5, if you need to. So we'll discuss that in detail. She's very entertaining, very funny, very intelligent, and we'll discuss in detail how those 1031s work. Now, one thing you've got to keep in mind, whatever Social Security number or tax ID number you're in, that's what you have to keep it in for it to be a 1031 exchange. You can't sell your houses and then go put your money in an LLC. It's going to have to stay in your name. You can eventually get it into an LLC, but in the initial 1031 exchange has to be the same tax ID number, either your Social Security number to your Social Security number, or an LLC tax ID to an LLC tax ID, and so on. All right, this has been the GetRealWealth.com radio show. I'm your host, Steve Davis. I hope I've shared some ideas that encourage you and enlighten you that it's all about the passive income. And buy your toys out of passive income, not out of earned income. We'll talk more tomorrow. Thanks for listening.
This has been the GetRealWealth.com radio show. Please remember that this show is for entertainment purposes only and should not be construed as legal, tax, or investing advice. Always get a professional opinion before making any investment decision. To find out about the mentoring and consulting at Real Wealth Academy, visit GetRealWealth.com and attend one of our free introductory workshops on real estate investing. That's GetRealWealth.com. Thanks for listening and have a great rest of your day.